Hi, I'm Bryan Crawford. You're probably wondering why I'm swinging. In the same way, you're probably wondering why we've seen such big swings in the interest rates lately. Well, there's a lot going on with interest rates. Number one, we have these large inflationary numbers, and those inflationary numbers, the Federal Reserve is bound and determined to stave off inflation by raising interest rates. If you make money more expensive and fix the labor market issue, perhaps we can stave off inflation. So, this week something interesting happened. Last week, interest rates dropped below 7%. Well, why did they do that when the Fed actually raised rates by 3/4 of a point? Well, interest rates aren't solely based on, especially mortgage rates, aren't solely based upon the Federal Reserve's numbers. They actually track really well with the bond market. A bond and a mortgage-backed security tend to move in the same direction. A bond is backed by the U.S. government, and a mortgage-backed security is backed by consumers. Both of those are fixed income assets. So somebody parts ways with a large sum of money in order to get paid back a little bit at a time with interest. Those swings in interest rates come from a few things. The CPI numbers came out last week. The Consumer Price Index showed that there was less inflation than we were actually expecting. That is what caused interest rates to fall below 7 again last week, even though the Fed raised them by 3/4 of a point. And what they're indicating is they're already building in the next Federal Reserve interest rate hike into interest rates currently, because they don't want to see a big spike of 1.5% like they did around Mother's Day weekend when they raised interest rates the first time, or the second time really. That risk was already there. When inflationary numbers came in below expected rates, what they know is that the Federal Reserve has been somewhat successful in staving off inflation with their aggressive interest rate hike policy. So they're less likely to do another interest rate hike in the meantime. So the other thing is that the bond market loved the fact that the CPI numbers were down. So the mortgage-backed securities is what funds mortgages. They track with the bond market. Both of those are what are considered fixed income assets, where somebody comes up with a large sum of money at the beginning with the goal of getting a little bit back every month with interest. The big risk that's involved in a mortgage-backed security in a recession is foreclosure. That's what happened in 2007 with these mortgage-backed securities and these junk loans. They were all getting sold off, and we saw a large amount of foreclosures, so it wiped out a lot of personal wealth. They're less concerned about foreclosures because of the lack of housing that we have in the U.S., and they are with reselling or refinancing those loans. So at a 7.5% interest rate, you're very likely to refinance if you see those rates come back into the 5s. And it's likely that in the future, if the economy starts doing well again and we're not seeing those inflation numbers, it's very likely that we'll be in the interest rates of the 5 again. So people are less likely to see a return within the life of the loan and to see those things being held long term. So, in turn, those interest rates go up so that they can make more money back on their money faster. So the volatility comes from those CPI numbers and the Federal Reserve doing what they've been doing, is that they're just concerned that interest rates might go down in the future and that somebody will refinance that loan, and all of a sudden your long-term payback happens all at once. So mortgage-backed securities track with the bond market. That's why interest rates are down right now, is because the CPI numbers came in better than expected. So thanks for watching. If I'm you, I'm probably buying a house right now.